Warren Buffett, a name synonymous with investment success, began his journey early. Even as a young boy, Warren displayed a keen interest in numbers and business. His fascination with finance was evident in his voracious reading habits, often seen with a book in hand, soaking up knowledge about the world of money. At age 11, his interest in finance blossomed. This was a pivotal year for young Warren, as he began to delve deeper into the intricacies of the stock market. He wasn't just a passive observer, he was actively learning and strategizing, trying to understand the mechanics of how money could grow. He purchased shares of Citi Service Preferred, marking his first foray into the stock market. This was not just a random purchase, it was a calculated decision based on his research and understanding. The excitement of owning a piece of a company fueled his passion even more. This early experience sparked a lifelong passion for investing. Warren's enthusiasm for finance was not a fleeting interest, it was a deep-seated passion that would shape his future. He spent hours reading financial news, analyzing stock performance, and dreaming of his next big move. It laid the groundwork for his future endeavors in the world of finance. These formative years were crucial in developing his analytical skills and business acumen. Warren's mind was always buzzing with ideas, constantly thinking of new ways to invest and grow his wealth. Buffett's childhood was marked by an entrepreneurial spirit. He wasn't content with just learning about finance, he wanted to put his knowledge into practice. From setting up lemonade stands to selling homemade crafts, young Warren was always on the lookout for business opportunities. He ran small businesses, demonstrating a knack for profit. These ventures were more than just child's play, they were serious business endeavors that taught him valuable lessons about supply and demand, customer service, and profit margins. He delivered newspapers and sold chewing gum, gaining valuable experience. These jobs were not glamorous, but they were essential in teaching him the value of hard work and perseverance. Each task, no matter how small, was a stepping stone towards his financial independence. These ventures instilled in him the importance of hard work and financial independence. Warren's early experiences were a testament to his determination and entrepreneurial spirit. They laid a solid foundation for his future success, proving that with dedication and a keen mind, even a young boy could make significant strides in the world of finance. Buffett's initial investment experiences weren't without missteps. He bought and sold stocks frequently, eager for quick profits. This approach, however, proved unprofitable. It taught him a valuable lesson. Successful investing requires patience and a long-term perspective. These early lessons shaped Buffett's investment philosophy. He realized that chasing short-term gains was a recipe for inconsistency. True success lay in identifying undervalued companies with strong fundamentals. This realization would become a cornerstone of his investment strategy. In 1949, Buffett's investment journey took a pivotal turn. It was a year that would mark the beginning of a new era for him, one that would eventually lead him to become one of the most successful investors of all time. He discovered Benjamin Graham's The Intelligent Investor, a book that would profoundly shape his thinking. This wasn't just any book, it was a treasure trove of wisdom that offered a new perspective on the stock market and investing. Graham's value investing principles resonated deeply with Buffett. These principles were based on the idea that every stock has an intrinsic value, which can be determined through careful analysis and research. They provided him with a structured framework for analyzing businesses and identifying investment opportunities. This framework was not just theoretical, it was practical and actionable, allowing Buffett to make informed decisions. Graham's concept of Mr. Market, an emotional entity prone to irrational behavior, particularly resonated with Buffett. Mr. Market was a metaphor for the stock market's volatility, driven by the whims and emotions of investors. He learned to capitalize on market fluctuations, buying undervalued assets when fear prevailed. This approach required patience and discipline, qualities that Buffett would come to embody. This contrarian approach became a hallmark of his investment style. By going against the crowd and trusting his own analysis, Buffett was able to achieve remarkable success. His journey, influenced by Graham's teachings, was just beginning, but the foundation had been firmly set. One of Buffett's key principles is viewing stocks as ownership in businesses, not just pieces of paper. He emphasizes understanding the underlying business, its competitive advantages, and its long-term prospects. This approach distinguishes him from speculators focused solely on stock price movements. Buffett meticulously analyzes companies' financial statements, management teams, and industry dynamics. He seeks businesses with a moat, a durable competitive advantage that protects their profitability. This focus on intrinsic value over market sentiment forms the bedrock of his investment decisions. Section 5. Decoding Mr. Market, Emotions, and Value. Central to Buffett's philosophy is the concept of Mr. Market. He views the market as an emotional entity, often driven by fear and greed. This irrationality creates opportunities for astute investors to buy undervalued assets and sell overvalued ones. Buffett advises investors to be wary of market hype and emotional decision-making. Instead, he advocates for a disciplined approach, focusing on intrinsic value rather than short-term price fluctuations. This detachment from market sentiment allows for rational investment choices. Section 6. Margin of Safety Protecting Investments. Buffett emphasizes the importance of a margin of safety when investing. This principle involves buying assets at a significant discount to their intrinsic value. This buffer protects against unforeseen circumstances or errors in analysis. The margin of safety provides a cushion for unexpected events. It allows investors to weather market downturns and capitalize on potential upside. This conservative approach mitigates risk and enhances the probability of long-term success. Section 7. Patience, the investor's virtue. Patience is a cornerstone of Buffett's investment philosophy. It's not just about waiting, but about understanding the value of time in the investment process. Buffett often emphasizes that the stock market is designed to transfer money from the active to the patient. This means that those who can wait, who can endure the ups and downs of the market, are often the ones who come out ahead. He believes in holding investments for the long term, allowing compounding to work its magic. Compounding is the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. This principle is often referred to as the eighth wonder of the world by many financial experts. This approach contrasts with short-term trading, which often incurs higher costs and taxes. Short-term traders frequently buy and sell stocks trying to capitalize on market fluctuations. However, this strategy can lead to significant transaction fees and tax liabilities, which can erode profits over time. In contrast, long-term investors like Buffett avoid these pitfalls by holding on to their investments for extended periods. Buffett's patience stems from his deep understanding of businesses and their ability to generate value over time. He spends a considerable amount of time researching and analyzing companies before making an investment. This thorough understanding allows him to remain confident in his investments, even during market downturns. He knows that a company's true value will eventually be recognized by the market. He's willing to wait for the market to recognize the true worth of his holdings, often for years or even decades. This long-term perspective allows him to avoid the noise and volatility of the market, focusing instead on the underlying fundamentals of his investments. By doing so, he can capitalize on the market's tendency to eventually reflect the true value of a company. This long-term perspective is a key differentiator of his success. It sets him apart from many other investors who are often swayed by short-term market movements and trends. Buffett's ability to remain patient and focused on the long term has been a significant factor in his remarkable investment track record. His approach serves as a valuable lesson for all investors. Patience and a long-term perspective can lead to substantial rewards. Section 8. Buffett's Wisdom, Timeless Advice. Buffett's investment wisdom extends beyond specific principles. He advocates for continuous learning, ethical conduct, and a focus on intrinsic value. His advice resonates with both seasoned investors and those new to the market. He emphasizes the importance of independent research, urging investors to understand the businesses they own. He encourages a long-term perspective, urging investors to tune out market noise and focus on intrinsic value. His insights provide a roadmap for navigating the complexities of the market. Section 9. Conclusion, the enduring legacy. Warren Buffett's journey from a young investor to a legendary figure offers invaluable lessons. His emphasis on value investing, emotional discipline, and long-term thinking continues to inspire generations of investors. his legacy extends beyond financial success. He's renowned for his philanthropy, pledging the majority of his wealth to charitable causes. His life and work serve as a testament to the power of patience, integrity, and a commitment to long-term value creation.